If you're not careful, you could pay tens of thousands of dollars more in taxes than you need to over your retirement. We're going to show you in this podcast some ideas on how not to do that.
Retirement Planners of America, RPOA.com.
Hello, everyone, and welcome back to the Retirement Planners of America podcast, where we try to have more fun than a human being should be allowed to have when talking about all this boring financial stuff. And I am your host, Ken Moraif. I'm the CEO and founder of Retirement Planners of America. And we work with people who are over 50, who are retired or retiring soon. And our goal is to help you to retire and enjoy your second childhood without parental supervision. That's what we call your retirement. And part of that is to make sure that you don't pay too much in taxes, because that could impact your ability to enjoy that aforesaid second childhood. So I'm going to bring my Chief Investment Officer Extraordinaire into the conversation. Jordan, how are you doing? Jordan Roach, how are you doing?
Doing great. Another one on taxes, I think?
Yes. You know, taxes, I hate taxes. I don't want to pay a single dollar more in taxes than I have to.
I think we get asked about taxes more than about anything.
Yeah. And you know what? If you do it right, if you do it incorrectly, rather, you could pay a lot of taxes. So we don't want to do that. So let's start off with just a basic question. What are the most common mistakes that retirees make when it comes to their withdrawals?
Well, I think there are two things that are related. One is you have a misunderstanding between the tax treatment of different types of accounts. So we're pulling money maybe aggressively out of certain accounts, and all that money comes out as ordinary income, and it suddenly pushes people into brackets they didn't think they'd be in. Some of that could also trigger Social Security to become more taxable than it would have been had you delayed.
You don't want that, no.
And that's not a good deal at all.
That's a bad
I've
thing.
seen that one.
Yeah.
I've seen even really aggressive Roth conversions, thinking a good thing, but then it turns into a bad thing because it pushes you into new brackets. So,
and you're paying more on your Medicare and all kinds of stuff.
That's exactly right.
Yeah,
so usually it's just not
news.
understanding the taxation between different types of accounts.
Okay, so what you just said basically is that we should think about how to sequence where we're going to get our money from during our retirement if we're going to get withdrawals.
Yes, absolutely right.
So let's go through that.
So traditionally, and everybody is different, but we have a couple sources of retirement accounts. You have your traditional kind of 401ks, traditional IRAs. Those dollars, money comes out as ordinary income. You have sometimes tax-free accounts, whether Roth IRAs or municipal accounts. And then you have brokerage accounts, taxable accounts. And so they're all taxed differently. But the traditional look on how we would do that, sequence withdrawals, would be taxable accounts first, right? We can push off then our tax-deferred accounts, let them grow tax-free, tax-deferred, until maybe minimum withdrawal age, which is in their 70s. And then you're going to save your Roth dollars for last. And that traditionally is how we would sequence things. But again, this can change between the balance of those types of accounts, income brackets that we're currently in, and all your needs.
Yeah, I've seen people, they're taking money out of their IRA because they don't want to touch their brokerage account. And what they're doing is they're paying taxes way more than what they would have if they took it from their brokerage account instead.
Absolutely.
So that interplay is super important. And, it doesn't sound like, it might make such a huge difference. But if it saved you even, $1,000 a year in taxes by the sequencing being correct, and, hopefully you live 30 years in retirement, you're talking about $30,000.
Could be used for trips, for kids' education, for Medicare premiums, like those things matter.
A lot of things that we could do with our own money that I think we could do better than what the government will do with it, right?
I think so.
Okay,
yeah.
so what about Social Security? Obviously, that's a huge part of most people's retirement planning. So how do withdrawals affect the taxation of Social Security?
Well, the one thing is, again, when you're taking Social Security, it's about the timing of it. And depending on the bracket you're in and seeing how much of your Social Security payment becomes taxable based on your other distributions. And so we always want to be very careful there, because I've seen this a lot where Social Security goes from a non-taxable state to all of a sudden a lot of it's taxable.
Yeah.
Because that's a problem.
And if people aren't careful, they could get into a situation where 85% of their Social Security benefits could be taxed.
Easy. And to get to that number, it takes a very little amount of distribution income to cause your taxation to go from 0 to now 85% of it is taxable. Not taxed at, but it is taxable.
Yeah, and by the way, ladies and gentlemen, we have a fantastic podcast on the taxation of Social Security that I think you should watch that explains that in some detail. So, okay, well, what about large distributions, in 1 year? You take a large withdrawal. Are there any risks with that?
There can be. Again, this is going to be depending on where you're going to take withdrawal from. Can we use a Roth account where this is going to be tax man's going to be involved? Or is this all coming out of a qualified account or an IRA or 401k? Typically, if we can, we like to straddle big distributions, big withdrawals over multiple tax years. Because if we don't, let's just say all of a sudden we want to do something fun, take a $25,000 trip and it's coming out of an IRA, well, that can trigger a cascade of, cascading problems where we have now it's more of our Social Security is taxable, Medicare premiums will go up, and then again, this is all dollars, and then your tax bill goes up. So it can be a problem.
I can tell you there is nothing that annoys our clients more than when they find out that their Medicare premiums went up,
The worst.
or the taxes. It's like, where did that come from?
Yes.
And it's because you did your withdrawals incorrectly and you forced yourself into the whole IRMA world, which we won't get into,
Yeah.
and other places where suddenly you're paying a lot more on your benefits, your Social Security and other things than you had planned. Let's talk for a minute about the greedy, unwashed, undeserving heirs that most of our clients have. Their kids, their grandchildren. And, sometimes like waiting, depending on how you do it. Like, for example, if I was one of the aforementioned greedy, unwashed, I would love to inherit a Roth IRA. Wouldn't that be awesome?
This is a great point. So we have to balance in sequencing withdrawals. It's the needs, right, of the actual savers, the investors, the clients, versus there may be a legacy or estate planning needs.
Yeah.
And so sometimes it might make sense, depending on how much they're trying to take care of the next generation, of taking those IRA withdrawals early and passing on Roth accounts, passing on brokerage accounts, because those have much favorable rules
Than IRAs do. Than
do.
Traditional IRAs.
Yes, exactly.
And by the way, ladies and gentlemen, I was only kidding about your heirs being greedy, unwashed, and undeserving, because I know that you've hosed them off, so they're probably pretty washed at this point. So please don't be offended by what I said. Yeah. All right, so let's talk about top tips for a retiree who wants to maximize their after-tax withdrawals. What do you think that would be? And again, this is a self-serving question, of course.
Well, I think one thing is, work with maybe an advisor that can help you model numerous situations on sequencing different types of withdrawals and a blend maybe between different accounts, and what that does to your tax bracket. Because this is about tax bracket management.
Yes.
And so somebody helping eyes on of here's where you are now, and depending on the accounts we're pulling out of, what does that do for how you're pulling across accounts? Huge. How does it affect Social Security, Medicare, all those things?
And you just reminded me, when you mentioned tax bracket management, one strategy that you could use is to drain your IRAs and keep yourself within the same tax bracket, so that when you're in your 70s and you have to take required minimum distributions, you could reduce your distributions then and reduce your taxes significantly.
Yes.
And so understanding what tax bracket you're in and the withdrawals from your IRAs, that's a very important strategy as well.
I mean, that's a great one, where I've seen where, you have clients coming in and they have very sizable IRAs. Well, those IRAs you think are yours, but they're not. The government's going to have control of you starting in the 70s.
There's a liability attached to that.
There is.
Right? Yeah.
So sequence those early so that you're not forced to take distributions you might not even need later and pull you into brackets and give more money away to the government that you don't want to be doing. Very, very important. So I think understanding, working with somebody to look through this, getting understanding what is currently the balance between all your different types of accounts and what could that imbalance create over a 10-year runway, hugely important.
Well, Jordan, thank you for that insight. Well done. So, ladies and gentlemen, like I said, we try to have more fun than a human being should be allowed to have when talking about all this boring financial stuff. So I hope you did, in fact, have more fun than you should be allowed to have. And thank you for watching. Please like and subscribe. And I hope this podcast found you healthy, wealthy, and wise. And we'll talk soon.
Retirement Planners of America, RPOA.com.